welcome to Investment 360. This is your wrap of the top funds and investment insights in South Africa and beyond. My co-host is Warren Dick. Now, coming up on the show, we chat to Adam Ebrahim, the CEO of the Oasis Group. Now, remember, you can follow us on Twitter at investment_360. First up, the Oasis Crescent Equity Fund was one of the first investment funds to launch that was compliant with Sharia law. Today, the fund celebrates its 15th anniversary. But has it been a good investment? And to the end of June, the fund has provided investors with a cumulative return of, wait for it, 1,933%, far above the average domestic equity peer group return of 664%. Adam Ebrahim, the firm's founder and CEO, joins us from Cape Town to share his thoughts. Well, first off, happy birthday, Adam.
Thank you very much, Bronwyn. I had a great day today. It's been a fantastic day.
Well, let's look at the 15 years that you've got under your belt. We've just referred to that outstanding return, cumulative return. And it's about investing, I suppose, in a simplistic way with morals.
Yes, so it's basically ethical investments and socially responsible investments. So we had an unmet need 15 years ago, which was ethical, which was socially responsible, and people wanted to protect and grow their wealth. And the solution that we've put in place has delivered that in an ethical and socially responsible way. So for an example, somebody who invested 1 million with us 15 years ago, that would be worth approximately 20 million today.
Adam, I'm sure your Muslim investors and the people that started out with you in those days are very grateful for that. I just wanted to get a bit of a sense of where the market is, because as I understand it, up until that point, Muslims could not really get access to capital markets. So whether it was in the form of fixed income or in the equity markets, were they just not able to participate in those two asset classes?
So people could invest directly on their own in specific stocks if they had the skills or they had the substance in terms of value, where they could go directly to a stockbroker or to an investment manager. But for the ordinary man in the street and for the ordinary person belonging to a pension fund, this wasn't a solution. There was no solution 15 years ago. And so what happened was that from an ethics point of view and social responsible point of view, you couldn't invest in casinos, interest-bearing banks, breweries, amongst others. So what the ordinary people were faced with was a dilemma that if they didn't invest and they left their money in the bank, inflation, which was very rapid in South Africa historically, would eat their capital and would diminish the value of their assets. And so what we put in place was a solution, an institutionalized solution, which gave ordinary people in pension funds working hard for South Africa to make South Africa proud, make South Africa productive, give them a solution where their hard-earned income could also be looked after from a wealth point of view and from an investment point of view, so that when they retired with a ethical, compliant investment that met their needs. And that's really what makes South Africa such a great place. It's an inclusive environment, a rainbow nation, and we must salute the father of this nation, Nelson Mandela.
Adam, let's just go back to the basic tenets of Sharia law. You referred to a little earlier in the discussion what you can't invest in, but perhaps just unpack it, because I don't think that many people out there are actually familiar with Sharia law.
Okay, so there are two, I'll split it into a couple of areas. Firstly, there is the area of what you can and what you're not allowed to do. So Muslims are not allowed to drink alcohol, so therefore you're not able to invest in those companies like South African breweries or distill. You're not allowed to participate in casinos, therefore you're not allowed to invest in casinos like Sun International. You're not allowed to earn interest-bearing income as a main course of your business, so the banks would be disallowed. And then companies like the credit retailers and furniture retailers who get a lot of their income, sometimes 50-60% of their income from interest-bearing instruments, would not be allowed to be invested. Then if you look at the second category, those are the interest-bearing instruments like bonds, where you're actually issuing a promissory note with no assets backing it more, and basically on the credit worthiness of the company. And you've just looked at this first step. The credit worthiness today was very different for them than what it was 2-3 years ago when, and so when things go wrong in a bond, they go wrong very badly. Whereas if you have a investment that is asset-based, and you can always fall back onto the asset, so the asset would be supported by land and buildings or whatever it may be. So you have one supporting one. You would not have financial gearing. You would not use derivatives. So this whole issue of the 2008 financial bubble, where it was really huge operating gearing and financial gearing by the banks and the hedge funds that created a bubble, it created an unsustainable situation which we're still trying to recover from in a Sharia compliant, because you don't have operating and financial gearing and you do not invest in those kind of highly leveraged situations. It's a much, much lower investment paradigm. And so if you look at the environment that we faced and the Crescent Fund, the volatility is much lower, the risk is much lower, and the returns, because of that, because you didn't experience the 98s and the 2008s and the 2001s, the overall long-term performance will be much, much better going forward, as it has been historically.
Your universe is relatively limited after you've extricated all the things that you can't invest in.
There's a big enough universe to invest in. And if you then look at, we back tested when we started the business, we back tested and found that, those companies that we couldn't invest in and those sectors that we couldn't invest in, actually over 20, 30, 40, 50 year period before we launched in 1998, actually didn't deliver that substantial outperformance. It came with increased volatility. So you've taken what we would call the sector of the market that didn't really deliver. You took that out, so you're left with a sector that over time will deliver. And then, since 1994, South Africans have been allowed to invest offshore. So 25% of the fund is invested offshore. So the universe is, there's just a plentiful supply of companies, property companies, and then also sukuks and other income generating. So the universe, there's plenty supply.
Adam, it's obviously, we're going to get to some of the detail around what you've been doing with the fund a little late in the show, but obviously with a 15-year track record now, it's a great time to look at perspective and just talk about some of the things that you've seen come and go in the market over those times. I just wanted to get your perspective. Obviously in 1998 when you launched, we were 4 years into the Mandela presidency, and we were also building up to the first, the dot-com bubble. I wanted to see and get your thoughts around the current environment we see ourselves in, with almost information overload in the current, at present, with the likes of social media and a range of ways in which people can communicate. Is there a massive amount of data and information that's available to investors making their jobs any easier at this point?
I think for the ordinary individual, what it does is the absolute amount of data and the way it's written and the way it's communicated actually increases the momentum of greed when the good news is there and stock markets are going up and financial markets are going up. So it actually provides a tailwind to that greed. And you then get bigger bubbles, things go up much higher. And then when things that are not so good and the news is not so good, then you get the reverse of that and you get fear. And you get the tailwind into fear. So with this huge access to information, transparency, real time, if something happens in Kathmandu, you'll know about it instantly in Cape Town. And that maybe, and it's done maybe before it's been analyzed, and people act on it before it's been analyzed. And therefore, you'll actually land up with greater volatility, greater potential for losses, and most probably an opportunity for people like ourselves who are patient, who are determined, who are analytical, and who are hardworking, to look through the noise, look through that euphoria and of greed and fear. So when people are greedy, like the retailers over the last 2 years, 20-odd PEs, they've done fantastically, high earnings, high PEs. We were very, very comfortable selling into those into the retailers, selling our retail stocks In 2002, when it was the reverse of that, when there was fear, we bought tons of retailers. And so our job is to be on the opposite side of euphoria and opposite side of greed.
So it sounds as though you're very much in line, Adam, with the Buffett principle there, to buy when others are fearful and to sell when others are being greedy.
I think we all subscribe to the Benjamin Graham school of investing, looking at undervalued situations. And those undervalued situations occur when people are fearful, and the overvalued situations appear when people are very greedy. So yes, we must probably come from a common root, and that's the Benjamin Graham school of investing.
Just very quickly, not very quickly, we've got a long time to chat to you, but before the break, sure, let's touch on your resource exposure and where you are exposed. Perhaps you can be a little bit more specific on the stock front.
Sure. So basically, where you are in resources, you've had 10 years of a boom time where disciplines went out, costs went out. So you basically had mines being brought online that shouldn't have been brought online. And if you look at, I've been investing for 25 years and as a professional investment professional, and there's been great times to be investing in resources and poor times to be investing in resources. The best time to be buying resources are when the commodity prices are below where they should be, and therefore a big chunk of the industry is unprofitable. In fact, the best time is to buy when 20, 30, 40, 50% of the industry is unprofitable. And if you can buy the lowest cost producer, the most profitable in that industry, a couple of things happen. The high cost producers close down. No new supply comes on board for a number of years, and normal economics takes its course, and you then get demand and supply, and with the supply being cut and future supply being cut, and the economy continue to grow, you will then get a rebound in price and then a rebound in value. So a situation that you face with some of the resource stocks, you're buying them on depression-like valuations with depression-like earnings, and therefore it's an ideal combination to stock up on those high quality resource counters and invest in them, and wait till the news improves and the high cost producers go out. And so our game is a patient game. Our process is a patient process. It takes time. And so we have to buy when the news is very bad and terrible. So you get those undervalued situations. So I'll start off with a couple of large caps, and I'll talk about 1 to 2 small caps. So in the large cap space, I think BHP and BHP is most probably the world's premier resource company. It's has got a marvelous array of projects and operating activities. They can expand their operations organically, and it's a very, very low risk, high quality business. So that's one that you want to stock away and put away for the long term for this recovery when it comes. Then Anglo-American.
Warren wants to jump in there with
BHP.
Warren wants to quickly jump in there with a question, but we're coming back to Anglos versus BHP.
Adam, I just wanted to get obviously the first question around the resources. I know value managers love using that term normalized earnings, where you look at what a resource company or an industry earns over the cycle. And obviously the big question we have around China is, when I think about the resource cycle and the big inflection points over the last 100 years, we had the rebuilding of Germany and Japan after World War II. We had the US extending its infrastructure in the 60s and the 70s. Was not the 90s and the 2000s, China, obviously the second most populous country on the earth. Is it not very distortive to look back over 20 years and expect the resource companies at the moment to offer value, considering that we've had such a huge event in the form of China industrializing over the last 20 years?
Good point, Warren.
I think it's an exceptionally good point, but these shares have come down very dramatically. The commodity prices have come down very dramatically, so they're below where the operating costs are. So China, I think, it's not going to fall off a cliff. It will have slower growth. It will have slower material and commodity intensity. However, you also just need to look a bit west, and you get India. a bit south, and you get Indonesia. Countries with huge populations that have a huge demand for infrastructure. They need to put in power, they need to put in transport, urbanization. And then we just need to look north of our borders with all our companies investing and, again, the compound effect of growth over the next 10, 15, 20 years after India. So I think India and Indonesia will take over the baton from China to keep some support to the commodity prices. And then Africa north of our borders will take over the baton when that happens. And so I don't think it's falling off a cliff. I think it's a lower level of intensity from China. But I think you would expect India and Indonesia and countries like that to come through because they're continuing to grow and they have a huge shortage of infrastructure, in particular energy. So we do not expect a tapering off and falling off over the cliff.
After the break, we continue our discussion with Adam Ebrahim, shifting our attention to market developments and where the Oasis Equity Crescent Fund has been investing its funds. I haven't forgotten to ask Adam after the break about Anglo American. We'll be coming back to that. Welcome back to Investment 360. Now, value managers have been having a tough time lately, but recent data suggests that the managers may begin to outperform the market indices. I'm sure there are a number of players out there that are going to breathe a huge sigh of relief. So where is the value to be found? And before the break, we were chatting to Adam Ebrahim, the CEO and CIO of Oasis, and he's joining us from Cape Town to share his thoughts. But we're going to kick off with Anglo American, because you were about to say, when it comes to Anglo American versus BHP, which you look on favorably, BHP, and then I interrupted you rudely. So where do we go?
Bronwyn, in 1989, when I started my career in the investment industry, Anglo American was the premier mining company of the world, and BHP was a dog with fleas. Today, BHP is the premier.
We like your
company in the
honesty,
world.
Adam.
And just go back into history. I mean, BHP was had a tough history to start off with. If you look at Anglos today, the roles are reversed. Anglos have had very poor management over the last 5 years, and most probably struggled with transforming from a South African business with a global footprint to a global business with a South African footprint. And so where we are today, I think BHP is just an outstanding company with, and it's good value. Anglo American has got some really good assets. Some of the South African assets are really good. The diamond assets, the iron ore assets are exceptional assets, amongst others. And yes, South African assets are good. They open cast and they're very competitive. And then let's look at the most difficult asset in South Africa would be the platinum asset, but it is the world's best platinum asset. What we do have is we have a breakdown in the labor relations between labor, government, and business. And sometimes you have to go over the wall or over the cliff. And unfortunately, Americana was that. And we're suffering from the consequences of Americana. However, when you're faced with a crisis, sometimes out of that comes a solution. And so we think that the solution's not in the next 3 months or 6 months, but 2 years down the line, they would have sorted out the competitiveness and of the platinum sector, and Anglo Plats would be the premium company to benefit from that. And then in South America, Anglos have got some really good copper, coal assets, and their problem child really has been, I sat in a meeting about 6 years ago where Cynthia Carroll said they're lowering their hurdle rate on investments. I was immediately alerted when she said that, because you're lowering your standards. And the net result is we hear Mark Katufani saying that they have got so many projects in the pipeline below the targets that they have. Now, Mark, we followed him very closely. I met him shortly after he was appointed in Barcelona. You know, I think he's a nuts and bolts person, and you can see it in the latest presentation, going back to nuts and bolts. So we think where Anglo's is, they need to do a little bit to get their operations right. They need to do a little bit to get the earnings right, and then the share price will take off. The shares most probably one of the most undervalued stocks you're going to find anywhere in the world, and you know, I think we've got all the confidence in Mark, but it's not going to happen over the next 6 months. Give him 2 years and look back in 5 years, and you'll think that, wow, that was a good time to be investing, and it was a great investment to look at.
Adam, I just wanted to, as soon as you're being so candid on your birthday here, I just wanted to see, obviously over the long-term perspective, when you look at companies, the only real difference, I guess, is the quality of the people running them. Do you think that the difference in the two companies' fortunes since the late 90s, how much of it has had to do with the people that have been running the organization? And here I'm also talking to the fact that the Oppenheimers stopped actively running the company many years ago, and they've used professional managers, whereas Billiton seem to have been able to recruit and employ some outstanding CEOs in the form of Brian Gilbertson and Marius Kloppers. So how heavily does it stack up for the two companies over the last 15 years, for instance?
Warren and I had a chat to Brian this morning. We had a call this morning at 10:30. Before Brian came along, BHP was in trouble. And Brian is a South African. He ran Gencor, then he ran Billiton, and then BHP. And that's why we're backing him and in Pallinghurst. And when you look at management play a material role in the development of the company, but also you've got to back it in a resource company. What is very important is the endowment effect of the actual resource and reserve that the mining company has. So BHP today has an excellent reserve and resource base. That endowment ensures that they will be very competitive over the next 20, 30 years. However, if they get poor management, it could delay that and retard that. But what we like is we like companies who really appoint their CEOs from within. We like succession planning, and that's what's happened with BHP. Brian Gilbertson, Marius Kloppers, and now Mackenzie. In Anglo's, basically what you had is you basically had Tony Treyer, who I know very, very well. Tony Treyer coming from a paper sector, running a mining company. He's done a fantastic job in Mondi, and Mondi is doing fantastically, set that business up. But I'm not sure if Tony was the right person for a mining company. And then from Tony, you went to Cynthia, who basically was too distant from the operations, was too distant from South Africa, and most probably, to give it the benefit of the hindsight of the doubt, is the fact that she came in the middle or the beginning of a commodity boom, and she wanted to get onto the train. But you know, these things take 5-6 years, and I think she made some very bad calls.
I see you were choosing your words very carefully while you were taking us through your ideas around the management team at Anglo American, and specifically Cynthia Carroll. Adam, what is your favorite stock going forward at the moment?
In South Africa, I think of the large caps, it would be Anglo's. On the small caps, it would be Pallinghurst. You know, in platinum, they're currently scaling up the operations. They're at the same cost as Anglo Plats, but with them scaling up the open cast operations, they will be the lowest cost producer by far. And secondly, they've got the strongest balance sheet in the industry, and it's run by a really great executive. They've also got a manganese business, which is now scaling up, and somewhere over the next 18, 24 months, the platinum business will kick into real good profitability. The manganese business will kick in, and then the emerald business in Zambia, and the ruby business, which are just starting in Mozambique. And from a long-term perspective, you've got the optionality of the iron ore in Australia and Fabergé. They're building the global brand. So from a small cap point of view, I think that's really a great mining stock run by great people with strong balance sheets, with low cost assets. And then from a global perspective, we really like the telcos. We dislike Apple. And reason why we've disliked Apple is the fact that if you look at hardware companies like Apple and Pioneer and Toshiba and Sony, what happens is they come up with great innovation. The time period for the next product shortens, and you just have to you just kind of run up down an up escalator with innovation, and then the competitors who don't innovate come along and compete with your core products, and that's what you're experiencing with the Chinese coming into the smartphone market.
I don't want to stop you because I've just got that 1,933% cumulative return over 15 years glaring above me, and I'm sure everybody is lapping up what you're saying right now. Unfortunately, we're out of time. But Adam Ebrahim, the CEO of Oasis Group, thank you so much for joining us. Thanks to my co-host Warren Dick. Now, if you'd like to get the schedule of guests and topics on the show each day, please follow us on Twitter. Our Twitter handle is @investment_360. After the break, stay tuned for Hot Stocks, where we'll be discussing the sin stocks with Ebrahim from NEFG Fund Managers and our resident expert Paul